Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Wednesday, February 26th, 2025. Today's episode, Robschild got a new camera. I decided to use some of the very generous donation money to get myself a nice camera to, reinvest the donations back into the show. I hope it makes the viewing ship a little more enjoyable. Thank you for subscribing, for liking, and for watching, and for supporting the channel. All the support is very, very much appreciated. Next item on today's agenda, the 10-year 3-month has gone back into an inverted state. Remember, with the 10-year treasury minus the 3-month, invert, uninvert, recession, invert, below zero, uninvert, recession, invert, uninvert, recession. What happens when we uninvert and then invert again? Well, it typically, it can extend the length before the recession, as we had seen going into the 1990 recession, and also going into the great financial crisis. We actually uninverted and then reinverted in July of 2007. And so in a way, in this little historic view, it pushes the recession off a little bit. And so I'm wondering if that's where we're at. The significance of this really boils down to the market pricing that within the next 3 months, we're still expected, the Fed is still looking like it wants to be tight here compared to, what's going on with the 10-year treasury yield. I want to mention here as well, if you remember, when the cuts started and then the 10-year yield started going up, everyone was talking about how bad that was and how, that was the bond market sort of screaming, hey, Fed, you're cutting too much too early, actually. And that's gone now. We're back into the camp where we're reinverting. The 10 years going down literally below the 3-month right now. So we're not steepening, we are inverting. I don't personally see this as being able to last very long, simply because inflation isn't heating up. Take a look at the break-even inflation rate between the tips. Again, tips are going up while gold is actually weakening here. That finally a little bit of reversion here. This is still dropping here right now. I see this as the market saying the market now believes the Fed is going to be behind on cuts, and so we'll see what happens out of all of this. But that's where we are. We're reinverted. It's historic. Yesterday we were at zero, and now we're back to an inverted state. Next on the agenda, the M2 money supply for January did come out today, essentially flat. Today at noon, the M2 money supply for January came out at 21,561 billion, and December's was 21,549 billion. So simply going up by, that's about $12 billion. That's good as flat in my book. And we're not climbing above the M2 money supply that we had in April of 2022, a bit higher at 21,724. I'm going to remind everybody that even during events like the Great Financial Crisis, the M2 money supply was not shrinking. It was growing during this entire period. If we get what looks like maybe even coming, it's possible for it to come, to have an M2 money supply contraction, that would be historic. Look at past recessions. Bad one in 1974. The M2 money supply was expanding without turning down at all, without many periods of much flatness. And not to say that today is just like a little bit flat, not to say that we can't go higher, but this is not a strong M2 money supply report for the month. Next item on the agenda, Nvidia earnings was expected to potentially rock markets in the after hours today. The after hours change went up by 1.7%. During the day, up almost 4%. And so maintaining this level, so apparently they didn't have terrible earnings. All in all, it seems like a non-event. I was thinking maybe this would be the moment where Nvidia is like, uh-oh, we're not making as much money as we thought, and this might crack the AI bubble. So it hasn't happened. It's not happening yet. Next item, just wanted to mention again, Thursday, tomorrow, we have M2 velocity that comes out. This can also be a very meaningful metric here. And then Friday, we have the inflation gauge that the Fed likes to use to determine what its monetary policy will be. The PCE, personal consumption expenditures, coming out. Seems like my computer might be getting a little bit laggy with this better camera. The next upgrade is going to have to be my computer. My computer's getting a little old. I'm not going to lie. We'll get there when we get there. But yeah, sorry about the lag if there is any for this show. I'll fix the settings if that's what's happening. Anyway, no major changes in the daily reminders. I'm not going to bother updating the inverted thing because we could pop back to the upside, especially if like PCE data comes in really weak and it's very clear the Fed's going to start cutting sooner. As it is, the Fed funds futures are now pricing 2 cuts, by the way, for this year, 2025. So that's a little bit of a new update too. Again, watch macro update 2/11/25 to hear me read my macro thesis. It looks like I am going to have to do a refresher macro update in the near future. It'll come when it comes. Crystal ball ratings are the same, and the portfolio, Robschild portfolio, is the same. Watch portfolio update 2/11/25 to hear me explain them. On to the charts. The SPX, the S&P 500, closing 0.01% higher than yesterday's close, going exactly flat for now. Guess Mr. Market wants to digest a little bit of data, maybe see how Nvidia is really going to perform here. The market, Mr. Market's a little confused. When is he not confused? But I digress. TLT, still my favorite place to be. I mentioned yesterday, this looks like a jump over the river kind of a thing out of this previous channel, suggesting that it's likely to continue higher, and that's exactly what happened today. TLT going up by another 0.6%. And its inverse partner, the TNX, the 10-year Treasury note yield, also dropping today. I wanted to scroll out on this chart today, the 10-year Treasury note yield, just to show that, maybe this Head and Shoulders giant top thing is, maybe this is actually the right shoulder here. It's starting to look like it. I had previously thought that, the peak in April of 2024, with this line here, was going to act as the, main thing that was going to break Treasury yields to the downside. Instead, we had a major bounce to a higher high than that previous high. And now we're headed lower. I just want to note, if you look within these blue lines here, you can see this line at the bottom. This does represent a new way to see Head and Shoulders top. This is a formidable, it's a perfect Head and Shoulders top developing really here. It's at a perfect angle. It's angling upwards, and it's the highest that it's been in a long time. If this were to play out, if we just take from the top of the head, drop it down to there, and then we were to, let's say, crack down from here, we're looking at a target in the 10-year note yield of 2%. That's right, 2% on the 10-year Treasury note yield. You heard it first here on Robschild. As was expected by the Robschild show, oil continuing to drop, not hugely today, but still going down. Gold looking bearish to me. This red candle, we engulfed 4 days. and now we're fighting at the bottom of the candle. This is a bear flag. It is, I expect gold to, just by this little chart pattern, to head down a little bit. If only I had been more patient with my thesis on Bitcoin. We did crack the line today. I didn't think we would, actually. I was, again, expecting, I guess, too much out of Monday's candle. I should have been a little more patient. And I definitely should have bought the strangle that I've been talking about with you guys for a while. It would have played out marvelously. I would have made... I mean, I wasn't planning on putting very much in there, like just tiny, tiny, tiny bit of my portfolio, but even small gains are worth trying to get, especially when you have such a beautiful setup like this. I mean, goodness. Anyway, as it stands, Bitcoin is looking very, very bearish right now. I hear chartists talking about, at the very least, getting down to the 75,000 level at the moment. I don't see it as having high enough of a probability to go short here, because it's not, I need a good setup and to get in at the right spot. Once the pattern's already in motion, it's like, it can go the other way on you at any time. And then what do you do when you're already, out of the money when it's going against you? It's like, earlier in the show, I mentioned Fed funds futures now showing 2 cuts in 2025. Everyone's been saying how, we only had the 1 cut priced in. Well, we have now September meeting now pricing in a 2nd cut. Again, I'm still in the camp. I think we're there. I think the market's going to start pricing in sooner, faster cuts at this point. I think I've said it a million times on this show, so many times that I'm like sick of even saying it. But when we had inflation after COVID, it went up, paused. Fed says we want to see it go even higher. It went higher, and then it seemed to get out of their control. They acted like it was out of their control. And they're like, all right, well, we need to raise rates like super aggressively. And they did, and it came down, and it paused again. And then what did they do? Did they push rates down to the floor because, they were worried about it going down further? No, they still kept them high. Now with the 10-year, 3-month inverted again, the Fed is essentially strangling the economy again right now. Inflation get out of control to the downside, disinflation, deflation. I think we're going past the 2% inflation goal to below 2%, maybe even negative. I highly, highly suspect this cycle we will see negative inflation or deflation. It involves the fact there is so much speculation priced into housing, into stocks, into all sorts of crypto markets, Bitcoin. I mean, when your neighbor starts talking about buying Solana, come on. Every cycle's the same. How long? People will never learn. People are always emotional, and they follow the latest trends, and they follow the sheep right off the cliff with everybody else. And yeah, I was going to bring up junk bond credit spreads today. Seems like the Fed chart's messed up because it's showing yesterday's data, even though it shows it was updated today. Anyway, moving on, the fear and greed index, we're still in extreme fear mode, all while the S&P 500, it hasn't dropped an enormous amount. It's not, this isn't like a COVID crash or anything. This might be a buyable dip, seeing as though the market is supposedly already in extreme fear. I don't know what Mr. Market's going to do in the extreme near. Last chart today, I wanted to bring up the S&P 500 90-year historical chart. I've referenced this chart many times in the past. It only updates like once a quarter. It has data for every month, but I've been waiting for this to update like forever, and it looks like it just got released today. I had been talking about on the show how we haven't seen earnings get as high as they were at the beginning of 2022. We were kind of stuck below that for a while, and that was extra concerning to me that, you know, bond yields have gone way up, the Fed's strangling the economy, and companies are not earning more money, and the stock market is going to the darn moon. So it should give stock market participants a little bit of sigh of relief to see earnings growth through January, February of 2025. However, I'm going to also note that from this level of 197.91 earnings per share of the S&P 500 rising to 210.62, this is about a 5% increase of the amount of money that the S&P 500 earns, and the price from that same peak before that dip in 2022 at 4,700 up to around today's price, around 6,000, is not a 5% increase in price, but a 26% increase in price. And again, with PE ratios being so enormously high still, and the CAPE ratio being so enormously high, I mean, so earnings needs to be way, way, way higher for the price of the S&P 500 to make any sense right now. And this is all while, you know, bond yields are not super low again, you know, above 4, and these are treasury bonds. You know, again, Graham likes to compare AA bond yields to the earnings of stock. We are still nowhere near any kind of equilibrium. Yields are strangling the market. You know, when bond yields are high, you know, these corporations that have earnings, they survive on borrowing money. And when rates are higher and they have to roll over their debt, the money that the company earns, they don't go to the company, they don't go to the stockholders, they go to the bondholders. The bond market isn't just this like little old man in a cave that doesn't matter. The bond market is the biggest market in the world. Bond lives matter. They don't not matter. And when they demand higher yields, stocks lose their luster. Unless you're Mr. Market and, you know, you don't pay attention to those kinds of things. I mean, how the heck can you get rich off of bonds, right? Anyway, that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.